That one should be in chemical engineering. I need to see your number on screen. Bridget Katwiri. You too, I need to see your number. James Meleka. Erekai. You need to see your number. And everybody else who is logging in should log in using both name and number. Now, let's start looking at the final chapter. It's called Chapter 5, and it's the financial plan. And this chapter outlines the sources of business finance and how they are utilized. It involves preparation of various financial statements that endeavor to prove financial viability of the business. So what you're saying in this chapter, you're going to give me a lot of figures in tables. And these figures should not just be figures, but they should be figures that are telling a story about your business. Because when you calculate these figures, this is now when you know whether the business is viable or not. And we are saying, although this is hypothetical, by hypothetical I mean it's not real, especially for a startup business, they should be as practical as possible. Remember, one of the characteristics of a good business plan, we said, is or practicability. So the figures that you're going to calculate here, you should they should be as practical as possible. And this is a very long plan because it composes of 9 subsections. So very fast, let's go through each section one by one and understand them. Some of the sections are very straightforward. Others are a little bit technical, but they're not difficult. So where it is very straightforward, you should be able to score those marks without any hassles. So let's start with the financial plan, the sections. By now, my assumption is that we have adequate, all of us have developed a business plan. And this business plan, I've looked at it from chapter 1 to chapter 4. Although what I've realized is that some of you have not given me anything. May I remind you that in business planning, it is always the first exam to be submitted, because what you are developing is basically what is going to be marked and graded. I'm excited, especially from the computer class, information technology class, because most of you have done the right thing. I'm very impressed. But I've not received anything from chemical engineering and anything from printing. And that's why I'm very concerned, because I don't know what is not happening. If I look at those, the numbers of those who are in, it is mainly the IT class. Yeah. And then there's one from printing class, that is Alan. There's one from chemical, because I know Chaka is in chemical and is the class rep. But Chaka, I'm telling you, I need to see your number. So what I would conclude is that the link has reached everybody. It's only that some of you think that classes are optional, but classes should be compulsory, and especially in a unit like this, where we meet for very few sessions and then the rest you do it on your own. Anyway, let's start with the first part, the pre-operational costs, 5.1. What do we mean by this? By pre-operational costs, we mean all the costs that you are likely to incur before you start the business. All the costs that you are likely to incur before you start the business. Look at your business idea. I'm assuming all of you are startup businesses. What expenses would you incur before the business starts up? Examples of pre-operational costs. Examples of pre-operational costs. At least everybody should be able to type one or two. Machines, that is okay. Charlo, I'm happy, that's okay. What else? What else? Everybody should type something, or should just say. So at least there are those machines, there are tools for those who are dealing with the merchanting or commercial businesses, initial stock, even deposits for utilities like rent, like water, like electricity, like rent, and so many. So what you're going to do here, you are going to create a table like this one. One side of the table, you'll have the item. Just state the item. The other side will have the amount. How much will that item cost? If, for example, is rent deposit, how much? If it is refurbishing, because sometimes you need to refurbish a building, how will you expect? So you have all the items and the expenses of each and every item, and you have the total. That one will earn you 2 marks very easily. So everybody should be able to understand that. Is it clear? That is the simplest, and nobody should miss this. Okay, we move to 5.2. Working capital estimation. Working capital, what is it? Working capital is usually referred to by another name as circulating capital. And it is the money that keeps on changing hands in a business on daily basis. The money that keeps on changing hands in a business on daily basis. That is why it is also called as circulating capital. And working capital signifies the ability of a business to successfully undertake current financial obligations because the business has a favorable liquidity position. What do we mean by that? By that we mean the business financial position is such that it has a lot of money that is circulating, and therefore it is able to carry out transactions successively. That is why we require working or circulating capital. And usually, working capital is calculated by subtracting current assets from current liabilities. Current assets from current liabilities. So that is it. Working capital. So now, how are you going to do it? You're going to have a table as shown. I don't know whether this one is, you can see it nicely, or I can expand it. This it is now bigger. So you can see you have item. The table has got 4 columns. Item, and in the items, we have the current assets and then current liabilities. Current assets in a business refers to those assets that are either in cash form or they are readily convertible to cash. So they could be in cash form, or even if they are not in cash form, they are readily convertible to cash. For example, stock. Because stock, you can sell it anytime and it becomes cash. Debtors. Debtors are those who owe money to the business. Maybe they had bought on credit, and anytime they can buy. Then we have cash. Cash is the most liquid of all current assets. So for the first month, you can estimate these requirements. The second month, you estimate. The third month, you estimate. Then you have current liabilities. Current liabilities are the immediate debts, like creditors. Creditors are those people who owe the business some money and they can pay anytime. Then bills. There are some bills that you must pay, and anytime they are due, you are, as a businessman, you are supposed to pay them. For example, water, electricity, and I mean expenses, especially the indirect expenses. Those bills that you must settle, internet, and any other bills that are due within a short period. We call them current liabilities. The moment you subtract current liabilities from current assets, you'll have a subtotal there. You'll have a subtotal there, and that is it. So subtotal. And that is how you estimate the working capital. Here, you may also want to give it in annual figures. If you want to give of year 1, year 2, year 3, you can do that for a month, then you multiply by 12. Is it clear? That is very straightforward. It's very, very straightforward. Okay. We move on. We go to 5.3, pro forma income statement. This is a bit more complicated. Pro forma income statement. This statement, by another name, it can also be called the trading profit and loss account. Trading profit and loss account. In most cases, especially in basic accounting, it's simply called a profit and loss account. And that is a statement that tells you whether the business is making profits or making losses. Let me try to upload so this statement is like that. I don't know whether you are able to see it. You can try to also have full screen. It's not very well visible. We try to upload a better version. My machine is so slow, it's I think even when I was giving you notes, I did give you this table. So it will look like that. I've given a different version because it's not any different from what we had there. It's only that this one is appearing better than the other one. So now you can see it has 4 columns. Year 1, year 2, year 3, and item. So how is it? You can see, let's start with the items. How do we prepare a profit and loss account? You are going to follow this format or this table. You have your sales estimates for the year. So what are your sales estimates for the year? Then from the sales, we subtract the cost of sales. For you to sell a product or a service, it must have costed you some amount to enable you to procure that which you are selling. Because the difference between what you are selling and how much you had purchased it is basically what we call the gross profit or the gross margin. So if you take sales, subtract the cost of sales, the answer will be the gross profit. But I would only put a rejoinder here that in sales, we are strictly looking at sales that are generating profits. In other words, what we call turnover. Turnover is the sales themselves minus what you may have returned. Say you are in a retail business, you have bought so many types of stock, but in the process of buying the stock and delivering, some may not be sold because it may not have met the standards for selling as it is. So you have to return that to where you had bought it. That is called sales returns. So that is why we are talking of, when you are talking of sales or purchases, when you are making a business plan or when you are estimating the gross profit, you have to talk of net sales or net profits. Net purchases, sorry. And the difference between the cost of sales, CGS, and the sales is what we call gross profit, the GP. Then we ask ourselves, is gross profit the real profit in a business? The answer is no. Because as you made that gross profit, which is the clear difference between the sales and cost of sales, you incurred some expenses like purchases, like payment of creditors, like salaries and wages, like rent, electricity, water, telephone, amongst others. So all those which are listed there are expenses which you must subtract from the gross profit in order to make what you are now calling net profit. So from the gross profit, you must subtract the total expenses. That is what I'm abbreviating as E. And when you subtract the total expenses from gross profit, we have what we call the trading profit. Up to that part, it is now called a trading account, because you can say in the 12 months of the year ending 30th of June 2025 or 2026, my trading profit was equal to this. Then, is trading profit the real profit? Is it the net profit? Once again, the answer is no. Why? Because you must make a provision for tax. So, tax is usually what you must pay to the government before you eat or share out to shareholders in form of dividends. So, from the trading profit, you subtract, you make a provision for tax, subtract that provision, and be left with net profit after tax. And you stop there. Net profit after tax. Note, in a business, for partnerships and sole proprietorship, because there is no limited liability, that is, there is no borderline between the assets of the owner and the assets of the business, then their kind of profits or their kind of tax is just a direct income tax. But for companies and other limited liability enterprises, they are guided by what we call the recommended corporate tax guidelines, which comes to around 30% of the trading profits, which comes to around 30% of the trading profit. So when I'm marking this, I would expect each one of you to make a provision of anywhere between 20 to 30% of the trading profit. That one is acceptable. The only thing that I would expect you to tell me below that table, you must have some footnotes. Say, for example, saying provision for tax is estimated at 25%. That explains how you arrived at the figure for tax. There is also another item there that I'm going to mention called depreciation. Depreciation is the loss of value of an asset over time due to natural wear and tear. Similarly, even depreciation is also estimated. And usually we use a method called the straight line method of estimating depreciation. By the straight line method, we mean it is assumed that an asset's value depreciates at a fixed percentage rate per annum. For example, if an asset is a motor vehicle, which was initially bought at 1,000,000 shillings, if you depreciate that vehicle at 10% per annum, then we can argue that the economic life of that vehicle is 10 years, because end of year one, 10% of 1,000,000 is 100,000. So end of year one, it will be worth 900,000. End of year two, it will be worth 800,000, because depreciation amounts to 200%, and so on and so on. So by the time it clears 10 years, it is presumed to have no economic value, or no economic life. That is the method I would like you to use when you are estimating depreciation. But that is not the only method. I know there are methods like reducing balance and others, but stick to straight line method of depreciation at a fixed rate, or at a fixed percentage per annum. So that is how that table should look like. It should not give you problems. Any questions? I want to move on to the next thing, but I am highly encouraging you to ask questions. If it is not clear, please let me answer the question. Joe is asking a very interesting question. What if it's a service? Will we still input depreciation? There is something you did not understand clearly. Joe, Crispin, that even when you are providing a service, is that for some equipment like furniture, depreciation is very, very low. But for some others like computers, the rate is high, because computer software becomes obsolete within a short while. So the rate of depreciation could be higher. So when you're estimating depreciation for furniture, I would not expect it to be the same as that of a vehicle or that of a computer. That has to be seen. So I believe, Crispin, I've answered you. Cindy, I don't know where you are talking about 30%, but the 30% that I've mentioned, I'm talking about corporate tax. This is usually for limited liability companies, businesses which are companies, whether public company or private company. The kind of tax that they pay to the government is called corporate tax. And it is it falls between 25 to 30%. And that is why I said in your business, if you make a provision of between 20% and 30% of the trading profit, I would have no problem. I would have no problem whatsoever. Any other question? So somebody was typing. Vanessa was not typing. I don't know whether she has stopped or she's finishing. I would have handled the question then. So back to our notes. So this table is basically the one that I've used, only that the other version is much more clear. So these notes are the ones that I've explained. The only thing is the last point. This point I did not mention, that when you show a loss or negative figure, use a bracket. So if your figures are coming to negative, instead of a profit of 10,000, uko na a loss of 5,000. You know, loss is negative profit. So you don't write it as negative, you write it with brackets. If you write it with brackets, that shows that it is a loss. So I think that is clear. I want to move on. Then we have the cash flow projection. This one was so big, could not fit into my notepad. So let me also download it so that excuse me, my machine is too slow. But what is important is for it to upload. It's uploading now. Okay. I hope it's very clear to all of us. This is now what we call a cash flow projection. A cash flow projection is a table that shows how money is flowing into and out of a business within a given year. Within a year, money usually gets into a business and is generated either through sales or sometimes those who are owing the business, they pay. Once they pay, so debtors is another source of cash inflows. And there are others here, I call them injections. Any other source of money that is incoming to a business. For example, you can sell an asset, you inject the money into business, that's an injection. For example, you can get a loan, you inject the money into a business. Or sometimes you can get a donation, you inject it into a business. All those collectively are called cash inflows. There's a small mistake there. That table, that should be cash in, CI, not C out. Total cash inflows. Then we have the cash outflows. Cash outflow simply means what expenses or how does money flow outside the business. It can flow out when you buy purchases or when you pay creditors, when you pay salaries, or expenses like rent, electricity and water, transport, when you service a loan and loan interest, when you pay taxes, when you pay for licenses, even repair and maintenance, even when you make provision for depreciation and so on. So all those are said to be cash outflows. So the side of cash inflows shows how money is getting into or flowing into a business, while the side for cash outflows shows how money is flowing outside or out of the business. Now, why are we interested in knowing how money is flowing into and out of the business? Because to some extent, the cash flow positions shows whether the business is trading in a healthy manner, whether there is adequate cash inflows to sustain